Your $300,000 mortgage stays $300,000. Your salary drops to $45,000. Welcome to deflation, where debt gets heavier and spending freezes. This is why central banks fear falling prices more than steady 2% inflation. When prices drop, everything's on sale, sounds great until you realize the sale never ends, your income is next, and every dollar you owe becomes harder to earn. In the next few minutes, we'll break down what deflation is, how it turns into a spiral, what happened when it ran loose in history, and how policymakers try to stop it before it locks in. We'll start simple and build it up step by step. Deflation, what it is and why the discount turns dangerous okay. So basically, deflation is when the general price level falls over time. Not just a sale on phones or gas dipping for a week, but a broad, sustained drop in prices across the board. That's different from disinflation, which is just inflation slowing down. Prices still rise, just more slowly. Deflation is prices actually going down, month after month. On the surface, that sounds great. Your paycheck buys more. Groceries, gadgets, maybe even rent feel lighter. But the simple version hides a critical twist: expectations. Think of it like this. If you expect a phone to be $900 today and $850 next month, you wait. For a phone, maybe not a big deal. But extend that thinking to cars, appliances, homes, business equipment. If enough people and companies delay enough purchases, demand drops now. Revenues fall now. Inventory piles up. Firms cut prices more to move stock, and the expectation that it'll be cheaper tomorrow hardens. That's the seed of the spiral. Here's the part most people miss. Debt doesn't deflate. Your mortgage payment, your student loan bill, a company's bonds, those are fixed amounts of money. If prices and wages drift down while debts stay fixed, the debt gets heavier. Every dollar you owe becomes harder to earn. That's the debt deflation idea Irving Fisher wrote about in the 1930s. Prices fall, debts don't, and the real burden rises, pushing households and firms to cut spending even more just to service what they already owe. Here's the math that breaks your brain. A 2% drop in prices doesn't cut your mortgage 2%. It raises your mortgage 2%. In real terms, in sweat, in what you actually owe relative to what you earn. On a $300,000 mortgage, that's a few $1,000s more pressure per year. On a corporate bond stack, that's a few percentage points more strain on cash flow. Multiply across an economy with high leverage, and you get a silent squeeze that doesn't show up in nominal terms until defaults jump. Meanwhile, wages and profits get squeezed. Employers don't like cutting nominal pay. It wrecks morale and retention. So instead of cutting posted wages, they freeze hiring, trim hours, or lay people off. Unemployment nudges up. That creates more caution, more saving, less spending, and the next round of price cuts. Everyone feels like they're protecting themselves, but collectively, they're tightening the vice. The simple version is this. Deflation shifts spending from now to later, while it lifts the real cost of yesterday's debts. That combo compresses incomes and margins, raises default risk, and makes the system brittle. The discount feels real. The squeeze is realer. Here's the mechanism that turns a dip into a downward spiral. Lower prices change behavior, behavior cuts demand, falling demand cuts prices further, and fixed debts get heavier at each turn. Once expectations reset to prices will be lower tomorrow, it's hard to pull people back to spending today. That's the trap. The spiral. How deflation multiplies pain. Through debt, jobs, and expectations. Here's what most people miss. Cheaper doesn't mean richer if your income is at risk and your debts get heavier. At the household level, a 2% price drop sounds like a raise. On the balance sheet, it isn't. If your paycheck slips or your hours get cut while your loan payment stays the same, your gain vanishes. For businesses, lower sticker prices don't help if volumes fall faster and fixed costs don't budge. The confusion costs time, and in deflation, time is the enemy. The loop works like this. Prices soften, people hold off, sales miss, inventories build. Firms respond with discounts and cost cuts. Revenues fall, margins compress, and layoffs start. Laid-off workers and nervous survivors spend less, so demand weakens again. Suppliers eat the shock next, then lenders, then back to consumers. Each spin tightens credit and confidence. The simple version: falling prices pull spending into the future and shove income risk into the present. Debt is the amplifier. Irving Fisher called it debt deflation. Prices fall, but debt is fixed in dollars, so the real burden rises. A 2% drop in prices sounds tiny, but it adds roughly 2% to the real value of every fixed payment you owe. On a household mortgage, that's a bigger bite of your income. On a corporate bond stack, that's a few percentage points more pressure on cash flow. Multiply across an economy with high leverage, and you get a silent squeeze. Now, the labor side. Wages are sticky. People hate nominal pay cuts, and businesses know cutting posted pay wrecks morale and retention. So instead of cutting wages, firms freeze raises, reduce hours, or reduce headcount. The result is higher unemployment or underemployment, even if official wages don't move much. Here's the paradox. Real wages can rise in deflation because prices fall faster than pay, but that raise makes hiring less attractive. Firms postpone openings, automation projects look better, and the job market weakens. Higher real wages, fewer jobs, that's the trap. Investment stalls for a boring but brutal reason. The required profit level is too high. When prices are expected to be lower next year, the money you make from new projects shrinks. A factory line that looked profitable at stable prices doesn't clear the bar if selling prices slide. The math breaks. So plans to buy new equipment get put off, R&D slows, and startups struggle to justify growth spending. The economy loses its forward engine, and that deepens the demand shortfall. Let me show you this in one company's balance sheet. A small manufacturer I worked with faced a 3% price decline across its product line after a big customer demanded cuts. They held list prices publicly, but offered quiet rebates to move stock. Revenue per unit fell. Input suppliers wouldn't match the drop, so margins compressed. Payroll looked oversized. They avoided wage cuts by freezing hiring and overtime. Rational, right? 3 quarters later, the bank revised their collateral values down based on lower inventory prices, trimmed their credit line, and a planned machine upgrade died. They couldn't expand even though demand was still there, just at lower prices. Now connect each decision back to the spiral. Lower prices, margin pressure, hiring freeze, weaker local spending. Suppliers feel it. Bank sees risk. Credit tightens. Investment dies. Every decision was rational in isolation, but together, it locked them into shrink mode. That's deflation at the firm level, and it's happening across thousands of companies at once. Here's the silent killer that breaks the system: the banks. Falling prices drag down the value of collateral: homes, commercial property, inventories. Lenders get cautious, loan-to-value ratios fall, and refinancing gets harder. Credit spreads widen because default risk rises under debt deflation. Banks tighten standards, which chokes off credit to exactly the borrowers who need it most. That's not spite. It's risk management. But when the credit channel narrows, even viable projects can't get funding, and more firms pull back. Expectations lock it in. Once households believe prices will be lower later, rate cuts and tax credits don't move behavior much. People sit on cash because cash gains purchasing power in deflation. The policy lever gets shorter and the time lag stretches. Central banks can shout, "We'll be easier for longer," but if the public doesn't believe they can reflate, the signal doesn't transmit. That's credibility risk, and it's why central banks hate letting deflation psychology take root. Here's the counterintuitive part. Even if unit costs fall with productivity, the timing still matters. If customers expect lower prices faster than costs decline, the margin gets crushed today, not tomorrow. Businesses won't scale output into a falling price environment unless they're sure volumes explode. That certainty is rare, so capacity stays on the sidelines and the economy idles below potential. So what breaks the loop? Usually pain. Defaults clear bad debt, currencies weaken to boost net exports, or policy overwhelms expectations with force. But left alone, the spiral feeds on itself. Heavier real debts, tighter credit, stickier wages, weaker hiring, delayed spending, and policy traction lost in the fog of doubt. The theory sounds abstract until you see it run in real time. Let's look at when it did. When prices fell for real. The Great Depression and Japan's lost decades. History already showed us what happens when deflation gets loose. Proven patterns beat theories because they reveal how people, banks, and governments actually behave when prices fall and fear spreads. The Great Depression, the fast collapse. Between 1929 and 1933, U.S. consumer prices fell by nearly a quarter. Unemployment blew past 25%. This wasn't a gentle correction. It was the spiral we just mapped, running at full speed. Prices dropped, incomes shrank, debts got heavier in real terms, defaults surged, and the banking system cracked. Banks failed, deposits evaporated, and credit vanished right when businesses needed it most. That's debt deflation in the wild. Balance sheets breaking faster than policy could stabilize them. Here's a useful contrast. The U.S. also had sharp deflation in 1920 to 21. Prices dropped quickly, industrial production fell hard, unemployment jumped, but the slump was brief. Why did 1920 to 21 end quickly while 1929-33 dug in for years? Severity and policy. The early 1920s shock was brutal but short. Prices snapped down, real wages adjusted faster, and the economy rebounded by 1923. In the Great Depression, policy mistakes deepened the fall. Sticking to the gold standard tightened money when it needed to loosen. Bank failures weren't backstopped, so each collapse destroyed money and credit. The lesson: if the financial core breaks during deflation, the spiral lengthens and hardens. Policy eventually shifted. The U.S. left gold in 1933, the dollar weakened, and reflation began. Programs under the New Deal supported demand, and banking reforms shored up the system. This didn't fix everything overnight, but it broke the psychology that tomorrow's prices would always be lower. The key was credibility and scale. A weaker currency boosted exports, deposit insurance stabilized banks, and public spending pulled some demand forward. The takeaway? Once expectations reset to deflation, it takes forceful, coordinated moves to unlock them. Japan. The slow squeeze. So that was the crash. But what happens when deflation is a slow, persistent squeeze instead of a sudden collapse? That brings us to Japan. Fast forward to Japan after the early 1990s, asset bubble burst. Land and stock prices collapsed, banks were stuffed with bad loans, and the economy slid into mild but persistent deflation. This wasn't a 1930s-style crash. It was a slow squeeze. Prices drifted down or flat for years. Real GDP growth hovered under 1% through much of the 1990s and 2000s. Picture a Tokyo salaryman in 1995. His stock portfolio evaporates, his annual raise disappears, and his bank still demands the same mortgage payment. For 2 decades. That's not a crisis. It's a slow erosion of expectations and confidence. The Bank of Japan cut rates to 0 and later tried quantitative easing. Fiscal packages came and went. Yet deflation proved stubborn. Why? Expectations and balance sheets again. Japanese households and firms learned to expect low or falling prices. When you think cash will buy more later, saving looks smart and investment looks risky. Meanwhile, banks nursed weak borrowers, so-called zombie firms, keeping credit tied up but not productive. Repairing bank balance sheets took years, and while that slow approach avoided sudden collapse, it also prolonged stagnation. Zero rates helped, but the policy transmission was weak because the private sector was focused on deleveraging. When the private sector is paying down debt, not borrowing, cheap money doesn't spark much new demand. Japan later added quantitative easing, forward guidance, even yield curve control. These tools lowered long yields and signaled persistence, but without a decisive shift in inflation, expectations and bank balance sheet health, the effects were limited. Demographics didn't help either. An aging, shrinking population lowers trend growth and makes demand harder to lift. The broader lesson isn't policy can't work. It's that once deflationary psychology settles in, you need a mix. Clean up banks fast, push sustained demand, and convince everyone you'll tolerate above-target inflation long enough to re-anchor expectations. The pattern, put the cases together, and a pattern emerges. Short, sharp deflations can end quickly if finance holds and policy loosens credibly. Prolonged deflation takes root when debt is high, banks are weak, and leaders hesitate. The hard part isn't cutting rates, it's shifting expectations. And that's exactly why modern central banks aim to prevent deflation from starting rather than trying to cure it after it sets.